Hey everyone, welcome to Fellowship of the Frugal. My name is Daniel. In today's video I'm going to talk about investing. So this is like an investing 101. So my goal is to let you know what some terms mean, kind of some basic intro ideas and terminology into investing, so that hopefully the next time you're at your neighborhood barbecue and the guys around the table are talking about their portfolio and you normally have that glazed look on your face, maybe next time that happens you'll have a little something to add to the conversation, maybe impress them a little bit. So as always, if you find this video helpful, I would love it if you would subscribe to my channel, check out some of my other videos, and I look forward to seeing you along the way to help you be smart with your money. Hope to see you again soon. Thank you. As I was preparing what all I was going to say for this video, I realized there are a lot of investment terms that are out there that I've just kind of grown accustomed to. I'm going to try to define as many of them as I feel are important in this video, but if I use a term that is foreign to you, that doesn't make any sense, and I don't define what it is, you can just do a quick search on it in the investment realm and you can quickly find out what it is. I try to use as little slang as possible, but sometimes I do let some slip, so I'll do my best to define some terms along the way, aside from the big ones, because in this video there are a lot of things that you can invest in, and I'm only going to hit on a few of the most popular ones in my opinion. That's going to be stocks, it's going to be bonds, mutual funds, and exchange traded funds, or ETFs for short. So that's what I'm going to discuss in this video. But to start with, we have to answer the question, what is investing? So simply put, investing is when you take your dollars and put it towards something, maybe a project of some kind or a company, with the hope to later gain some sort of reward or profit because of your dollars that you put into it. Now, you can be directly involved in the work of the project, or you could not be. That doesn't matter. But either way, you put some money into it with the hope of gaining a future reward. So the way that this is different from savings is the goal is different. With savings, the goal is just to not lose money, and it's generally short term as well. Investing tends to be a longer term strategy, meaning I'll just say more than 5 years for this case, and anything less than 5 years would be in the savings vehicle, just because you need to be able to get your hands on it. And a lot of investments are a little harder to get your hands on in a quick time frame. It's not always the case, but it can be. But investing is a long-term strategy, more than 5 years out, depending on how close you are to retirement or whatever your goal is. Savings is just trying not to lose your money, whereas investing is really trying to grow your money. Because let's be honest, if you're just putting your money in a savings account, it's really not going to grow. You're not going to lose anything other than spending power, but that's another discussion. But your interest rate is going to be so low that it's not going to outpace inflation. The only shot of doing that would be in the investment world in one of these vehicles that I'm going to talk about. So with investing, you can lose the money that you put in, but you can also get a much better reward. So there's what's called a risk reward factor here. The higher the risk, the more potential for a reward, kind of like with stocks that I'm about to get into, versus a savings account. The reason the reward is so low is because the risk is so low. There's basically no risk to it outside of FDIC coverage, but the risk reward factor determines what you could potentially get as a rate of return. There's also something called a ROI, or return on investment, and all that means is you're trying to get more back than what you put into it, which is the hope with investing. Nobody invests in something with the hope of losing it. You hope to get more money back than you put into it. And so what are some ways that you can do that? There are lots of things that you can invest in, but in this video I'm going to talk about what I call the big four. That's going to be stocks, that's going to be bonds, that's going to be mutual funds, and that's going to be exchange traded funds. So let's get started with stocks. Stocks essentially represent ownership in another company. There is a issuing company, that's the company that issues the stocks, and a person or other legal entity can buy the stocks. Just for our video, we'll assume it's a person. But a person such as yourself can buy a stock in a company that offers stock. Now, not every company out there offers stock, only some do. But the chances are, if you think of a company that you're very familiar with, is very well known, very publicly well known, maybe a franchise that's all over the place in the US, more than likely that company offers stock. But if you're unsure, you can always do a search for the company name and then put the word stock in there and see if it has any kind of stock that's offered on it. So as I said, it represents ownership. So when you buy one share of stock in a company, you buy a share of ownership in it. Now, does that mean that you're immediately the CEO and top dog when you buy a share? No, there's probably millions of shares out there, and whoever holds the highest percentage of shares is going to be the top dog shot caller, but there's usually still a board of directors and all kind of stuff. But let's keep it simple. So the more shares that you own, the more votes you get, the more ownership percentage you have in the company. Now, there's two types of stocks that are offered. The first one is common stock. With common stock, this is the type that gives you voting rights. So for every certificate of stock that you have in a company, you get a vote in maybe like a change of leadership, for example. You'll get a letter or an email telling you to vote for something. If you have multiple shares, you get multiple votes in that. Also with common stock, if a dividend is declared with the company, then that could potentially be paid to you and you can share in that profit. Now, the other type of stock is a preferred stock. This is the second type. Preferred stock, you don't get voting rights on it, so that's going to be different from common, but you also, as a preferred stock owner, get the preference or the priority of payouts, whether it's a dividend payout or whether the company has gone bankrupt and is paying out the last of its assets. Preferred stockholders come first. And by stockholder, I just mean a person who owns at least one share of stock. You become a stockholder, is all that is. So there's two different types. You can have both. You don't have to have all one or the other, but it depends on what you want to do. In fact, it's common to have both types. So that way you get some votes and you also get the preferred preference on payouts should they come. Now, if the money that's being paid out as a dividend is exhausted and you haven't made it through all the preferred stockholders yet, then the common stockholders aren't going to get any. There has to be some left over after all the preferred stockholders are paid. Stocks have been a very popular option for a long time because historically they outpace inflation. In fact, if you look at the historical averages on the S&P 500, for example, which is just a stock exchange where stocks are sold and purchased. But if you look at the history from 1928 until the end of 2022, the average annualized return was 9.82% per year, which is pretty good. That's higher than inflation has been. So people like stocks because you get a chance to earn more money than you would in other ways as well. Of course, you can also lose the money. There's always a risk of that. But historically, stocks have done much better at growing your money that you put in. So that's why they're a popular option. Now, the price of stocks have a huge range. I mean, you could buy into a stock for as little as a penny, or it could cost you thousands of dollars to buy a single share of stock. But most commonly, the ones that you see are going to be between about $10 and maybe $500, somewhere in there. Again, they're all over the place, so it just depends on what company you're looking at to buy. But the range is all over, and so it could be a penny, $1,000. You'll just have to look to see which company you're buying into. All right, so now I'm going to talk about the next vehicle, which is going to be bonds. So bonds are debt instruments. Earlier I said stocks are like ownership and you buy some ownership into a company. With bonds, you're not buying ownership, you're just buying a company's debt. And it can be a company, it can be a government. That's very common actually. And so if a company or a government is trying to raise money for something, it's very common to issue bonds. In fact, if you live in a city where there's some sort of major building project that your city is putting on, more than likely they sold bonds to pay for it. I know in my city they just built a major water park in town and they sold bonds to help fund that because it was millions of dollars to fund it. So that's actually very common when a city's trying to do a big building project. They usually sell bonds for it. Now there's many types of bonds, and I'm not going to get into the different types of what they are, but I want to let you know as far as what you need to know now in this video that they are debt instruments. Usually they're sold at what's called par value, which is $1,000. So like one bond would be about $1,000. It's not always going to be exactly $1,000, may give or take, just depending on what's going on. But just for our sake, you can just think that each bond is going to cost $1,000. But there's going to be a day that you purchase, and there's going to be a maturity date. When you buy it for $1,000, you have the hope that whenever the maturity date is reached, that you'll get $1,000 back. but along the way you get interest payments. So that's why people buy these. It's not here's $1,000 and then get $1,000 back. You get interest payments along the way. Those can be paid monthly, those can be paid annually, or somewhere in between. But you'll know before you buy one how frequently the interest is going to be paid, if any at all. Now these have a range of safety. You can have what's called extremely safe bonds or very speculative bonds that can pay you more because they're riskier. There's a chance you could pay into it and not get any of your money back. That's always a risk. But some are considered very safe and have been around for many decades. As I talk about any of these, there's no guarantee that you're going to get your money back, but just know that there's always going to be a risk. But in general, bonds are considered safer than stocks. There's less risk of you losing your money. So if somebody is more of a conservative investor, bonds are a better option than stocks in that regard. But you also are not likely to get as much of a return if you're going to get a return. And the last thing I'll say about bonds is if you buy one, you can actually sell it before maturity. So there's trading on bonds all the time. So if the maturity is, say, 5 years out, then it can be traded multiple times in the 5-year period. So that is an option. You don't have to keep the thing for the whole 5-year period. You can sell it along the way. So now I'm going to talk about mutual funds. So with stocks and bonds, not everybody has the kind of money needed to buy into those. Not everybody has $1,000 or more to buy into a share of a stock or a bond. So what do? Well, that's where mutual funds come in. Mutual funds are basically pooled investments from a large group of people where they want to put a bunch of money into a collection of different funds and try to accomplish a return goal or a growth goal or some other type of goal or income. There's various reasons to get one, but let's just assume for this that your goal is to grow your money with the least amount of risk possible. So earlier with the stocks, I mentioned that they have traditionally outperformed inflation, and that's true. You can put all your money into a stock and it can double in a year. That can happen, but you can also lose everything within a year. With mutual funds, since they tend to buy multiple stocks within the fund, if one stock company goes under, then that doesn't mean you're out all your money. It just means you're out a percentage of whatever ownership in that company was. So these mutual funds can be billions and billions of dollars, and you can have $1,000 into it and own maybe a percentage of the share. But you can invest, just say $100 a month, month in, month out, and buy shares of mutual funds. They're going to have a fund manager, so someone is going to be in there picking which stocks, which bonds, which things to buy within the fund. And you also have a wide range on what your interests are for what kind of mutual fund you can buy. If you're really into technology fund, you can buy a technology mutual fund. If you're into the finance industry, you can buy finance mutual funds. If you like energy, you can buy energy mutual funds and fixed income. And there's all types of different mutual funds that you can buy into. Each one is going to have a fund manager, going to have a percentage of a fee that goes to this fund manager as a cost, so you don't get exactly 100% of everything you put in or as potential profit. Some of it's going to be taken out for the fund manager, but that's expected. I mean, they're trying to help minimize risk and maximize returns, so they should get paid to do that. But these are very popular options, at least for getting started with investing, just because you have a chance to gain rewards that are higher than inflation while minimizing the risk. So the last investment vehicle I'm going to talk about is an exchange traded fund, or ETF. Now really what this is, it basically operates like a mutual fund. It's like a pooled investment into a number of different funds, but they are made to mimic a certain exchange. So of course the E stands for exchange. An exchange, as I defined earlier, is where stocks and bonds or other things are traded. So for example, the S&P 500 is the most popular one in the United States. There's different ones all over the world that go by different names and have different funds within them. But here the most popular ones are the S&P 500 and the Dow Jones Industrial Average, or the DJIA. And so if you buy an exchange traded fund that's meant to mirror the S&P 500, what you're hoping to accomplish is if the trading day ends and the S&P has gained half a percentage point, you expect that fund that you bought to also have gained half a percentage point, because it is meant to match that exchange. Now there's a lot of different exchanges, so there's a lot of different ETFs that you can buy. But if you like the S&P 500, if you look at the history of it, as I said earlier, with the annual returns for the last almost 100 years, and you say, okay, well, I'm going to buy this S&P 500 ETF, and then that's going to hopefully get almost that 10% annual return year over year after a long period of time. And that's the hope, and it's designed to do that. Of course, if the S&P 500 drops in a day, your ETF is going to drop as well. But as I said, ETFs can match the performance, it can match the good, it can match the bad, but it's meant to match the exchange that it's geared towards. Lots of different exchanges, lots of different ETFs can be used. These are also popular options for getting started with investing, because some people are just overwhelmed by the thought of it. And so what they can do is say, hey, the S&P 500 has done well, I'm just going to buy an S&P 500 exchange traded fund and just hope for the best. And that's actually not a bad idea for most people anyway. If you don't understand the stock market, or if it's just overwhelming to you, that's usually a good way to go, because the exchange itself tends to do well, at least over a long period of time. And so the hope is that your ETF will do well as well. So as I said earlier, there's a lot more things that you can invest in. That's not near the full number, but with these four, I thought these are the most popular and the best place to get started with just learning about investing 101. So hopefully, as you hear some of the terms that I mentioned in this video at the neighborhood barbecue, then you'll know more what they're talking about. Of course, I'll have other videos out there that go into more depth about certain things, but this is a great place to start if you really know nothing about investing. I hope you really gathered some information from this that you can use, and be sure to check out my other videos on investing as well to help kind of solidify what your vocabulary is, what the terms are, because those of us who are in the investment world can very casually name off all kind of terminology and jargon in the business without even realizing how foreign it sounds to most people that aren't in the business. So hopefully this helps. Hope you get a chance to subscribe and check out my other videos, and I hope to see you again soon. Thank you.